has tried to bring about a different approach to business news, economic news, and equity market news over the last few months that we've launched. We are now adding a fourth large element to our coverage with the launch of Portfolio, a brand new personal finance offering. As the name suggests, Portfolio will try and address your portfolio queries. How should you allocate or asset allocate, and what should be the quantum within each of the sections to ensure that your portfolio easily enables you to meet the goals that you may have. We kickstart the coverage with a very special bunch of guests. A few weeks ago, Saurabh Mukherjee, Rakshit Ranjan, and Pranav Bunyal released their book called Coffee Can Investing. I have that book with me. We requested them, after reading the book, to spare some time with us to talk about how people can plan their financials and create a robust portfolio. And we have them here to share their expertise on the subject, as well as use some of the facets of this very interesting book titled The Coffee Can Investing. Gentlemen, thank you so much for taking the time out and joining us.
Thank you.
No, a pleasure having you. I mean, if we couldn't have thought of a better start to this personal finance foray from Bloomberg Quint without Coffee Can Investing, and much unlike what an average person would believe, that Coffee Can Investing would only be about equities, this book is about a lot more. And I believe that you guys also believe that an ideal portfolio should be a lot more than just what stock should be there in your portfolio.
That's right. So the reason for writing the book was that we were encountering lots of investors in their late 40s, early 50s, whether they're owners of small businesses or executives, and these people had 10 years to go to retirement, right? And we could see that their financial corpus was nowhere near enough to have a reasonable retirement. So if you assume that to have a reasonable post-retirement life, you need, say, between 50 lakhs to a crore of income after tax, you need to retire with a financial corpus of at least 15 crores in India. And very, very few people we were encountering had that sort of corpus. And so that got us thinking that what's happened in India over the last 10, 20 years is, whilst we have created wealth, a lot of that wealth has gone into real estate, gold, assets which don't really create cash flow. And if you don't have cash flow, you really are in trouble after retirement, right? So that's where the idea germinated from, that let's create a book which helps people in their 40s, in their 50s, save wisely, save properly for retirement. And we're trying to do our best to give them the final 30, 40 years of their life where they have plenty of cash coming out from a well-structured financial portfolio. And that's the crux of Coffee Can Investing. That's why we put the subtitle as The Low Risk Route to Stupendous Wealth. It wasn't meant to be a marketing gimmick. We genuinely have tried to create the low risk route to a happy retirement, to stupendous wealth.
Yeah, wouldn't all of our investors or viewers who are watching right now want that? A portfolio which is low risk and leads to stupendous wealth. Right. There are some very interesting charts. By the way, I've read almost all of this book twice already.
Okay, kind.
It's so interesting. Also, I had to prepare for the show, by the way. But yeah, let's talk about some of these things, and all of you just jump in whenever. But I'm starting off with this life chart, a typical senior executive's lifeline that you guys have illustrated in this book very nicely, and it'll come up on this wall as well, and on this AR rather, and you will see that, and you guys have portrayed it well. This is typically how people have come down and rather progress in their lives, right? They start off with a good education, then a good job, then propose for marriage if they do, or the marriage is arranged, and then the financial difficulties begin because they don't plan well.
Absolutely. Right. So along with this chart, there's a statistic that I would like to share. It's already a part of the book. 95% of Indian savings is actually in physical assets. It could be real estate, it could be gold, or it could be consumer goods. Right. The point is that what we are seeing now, the economy is opening up, the market is opening up. You'll see a lot of people who investing into mutual funds. That hasn't been the case for people who are, let's say, into their 40s and 50s. Right. For them and for most of us here, our investments has primarily been into those physical assets that we talked about. Now, except a 10-year period between, let's say, 2003 to 2013, these physical assets haven't done too well. And what that has meant is that for most of these guys who have been earning well, who have been saving well, and yet the corpus that they've built for let's say the next 10 to 20 years, or for fulfilling their goals, including their kids' marriages, etc., is not enough. right? And that's something that we actually see for a lot of HNI clients that who we service to as well. And remember, not all HNI clients are either 1,000 crore or let's say even let's say 300, 400 crores. There are some clients like that, but typically a lot of the HNIs are CXOs of various corporate houses, senior level positions, right?
Quantify that misallocation. Last year, the RBI published a report in August called the Household Finance Committee Report. The RBI said that 95% of Indian wealth, 95% of Indian wealth is in physical assets, gold, real estate, consumer durables. If you or, and we know from the RBI, the country as a whole, if the country as a whole is heading for retirement with only 5% of their portfolio in financial assets, then there's millions of people out there who need portfolio restructuring, right? And we're not just saying this basis anecdotal data, we're saying the central bank has put this work out, suggesting that there is a massive need for portfolio rebalancing away from physical, away from real estate and gold into financial assets. And that's the backdrop against which this book has been written. That's the backdrop against which people out there, people watching this program, will be doing their lifetime saving and retirement planning.
Yeah, so I want to get a very interesting graph that you guys have given. This is exhibit number 2 in the book. This is, well, they've used the term Mr. Talwar's portfolio and the annualized returns each asset class generated for him since 1990. But this could well be true for almost anybody, right? Let's get that chart up on the screen and we will show you. This is typically a portfolio of almost every middle-aged Indian or a lot of middle-aged Indians. And this is what will happen. Some portion in cash, some portion in FDs, gold, maybe loan to developers if you are rich enough to do that. Stocks is a measly small percent and some upticks that have come in. But if guys, my question to you, that what you're trying to do via your book and what people should ideally do is try and change the mix of the set in order to help them get better returns, right?
That's right. So one interesting feedback that we've got since we published the book is a lot of people that we meet, they'll say, well, my equity portfolio has delivered 17% in the last 10 years or 25% in the last 3 years. Everybody's done well in India in equities in the last 3 years if you think about it. What they don't do is they don't think of their portfolio in totality. They think of the happiest part of the portfolio and they cite that number to us. That's perfectly fine. It's perfectly good for cocktail party discussions. But as we highlight in the book, most people in India have a portfolio allocation just like Mr. Talwar does, as a result of which, over the last 20 years, their annual rate of return from their portfolio is barely 4-5%, i.e. they had not even kept up with inflation. And that means in the final 10 years of your life before retirement, final 10 years of your career before retirement, you have to really redo your portfolio big time, right? So this happy recall of the nicest part of our portfolio is a problem that even I suffer from. But if we look at our portfolio in totality, including real estate, gold, fixed deposits, we haven't actually made that much money in the last 20 years. And that's going to bite big time in the next decade.
Okay, and we're going to talk about these happy moments as well in coffee can conversations, and that's coming up in a bit. But Pranav, if I can take one question, and again using an ideal financial goal exhibit that you guys have given in the book. A lot of us or a lot of people out there have these goals, right? The higher education for their sons, their weddings, buying maybe a holiday home or a second home, buying that expensive car which has always eluded them. And I think you guys have depicted that also very, very well. I mean, what would the recommendation be? We are going to be designing active portfolios for some queries that have come in as well in the second episode. But for the first episode, this is what you guys have given. I mean, these are financial goals that a lot of people have. I've depicted again Mr. Talwar's hopes that he had. What are you guys trying to say here? Should people actively or have an ideal percentage into different quadrants within their financial investments in order to meet these goals?
Yeah, see, for example, this guy is around 50 years, right? And he has these goals. And ideally, for a lot of us, a simple thumb rule for investing or asset allocation is 100 minus your age should be your equity allocation, right? But what happens to such a guy who, well, 100 minus 50 is 50, but he doesn't know how that does that juxtapose with some of his goals, right? So our thesis is that asset allocation in isolation is a futile exercise. Okay. You first have to write down your goals, right? And the thing about these goals is an 80 lakh, for example, for a particular marriage or let's say higher education, you may want to spend 50 lakhs to an 80 lakhs amount. Now that amount is something that is equivalent to your rupee value today. Right, in 5 years' time, that actually will balloon as per the inflation, right? And that's something that people forget. That something has to be part of your financial planning exercise. A simple Excel will do. In fact, we have shared that Excel sheet as part of the book, but listen guys, you can actually make your own. It's pretty straightforward Excel calculation. But the fact is that once you realize that your asset allocation is a resultant of your goals rather than an isolated exercise, then I'm just trying to really put it simplistically.
Yeah.
If you assume that you would, let's say, earn around 15% per annum from equity, and you should earn anywhere between 7 to 8% from debt, right? So then on one end is your 8% return if you put all of it into debt, 100% allocation into debt. On the other end is 15% if you put 100% into equity. And we're not talking about coffee can yet. We would like to believe that coffee can get you much higher returns. But the fact is, your returns then would vary between 8 to 15%, let's say 15% on the other end, which is coming out of Nifty, and which has been shown to be the stock market returns over long periods of time. So then you really have to tweak your debt and equity, right? Again, a very straightforward allocation, straightforward exercise to come out with a return that will meet up with the financial planning requirements. Now, from that financial planning requirements or the exercise, your rate of return, and that's something that we've actually done it for quite a few clients, and it comes disturbingly much more than 15%. It comes to 18%, 21%. For some of us ourselves, the return has been, the required rate of return is pretty high. So obviously one measure would be to actually tone it down. You realize that, look, there are some goals that you probably may not be able to meet, at least as per the current calculations. But do remember that the financial planning or the asset allocation is also a slightly dynamic exercise. You want to do it, let's say, every year or every 3 years, depending on your cash flows or existing cash flows, etc.
Just to elaborate on Pranab's point, for people like us, inflation is more like 7%. That's after tax. So therefore, just to deal with inflation, even if I had no children to send to college and no retirement to plan for, I need a return of around 10% just to deal with inflation. If over and above that, I have some modest goals around children's education, my own retirement savings and so on, it's very difficult to live in India without having a portfolio which is throwing off 15% with reasonable amount of regularity. Now, as soon as we say 15%, the portfolio becomes inclined towards equities. But if we throw our entire life savings into equities, we're putting our future in real jeopardy. That's the dilemma you're dealing with. And hence, anybody who does anybody who's saving in India without a proper fix on their goals is as mad as someone who sets out on a journey without knowing where they're going, right? And unfortunately, there's a lot of that in our country. People are saving, they don't actually know what they are saving for.
Ladies and gentlemen, start now. Do put it out on an Excel sheet or a piece of paper as to what your goals are, and then start figuring out, based on your cash flows, how can you reach them best. A heady mix of all asset classes. For all of you who haven't done that and now need this 15, 16, 18% for the lofty goals that as our guest said, you may have, fear not. There are probably ways to do it via investing in equities as well, and I think that's the other part of this book, and where you're talking about how coffee can investing, and I would request you guys to explain this in greater detail. Rakshit, maybe you want to come in here, that there is a methodical way of investing in equities which can hopefully lead to sustained, enjoyable returns over a period of time.
Yeah.
What do you want to elaborate?
So see, the reason why coffee can is one of the ways. It's not the only way. It's one of the ways to get that outcome, sustained appreciation in your portfolio value at a healthy rate, regardless of how volatile the external environment could be. Right. The reason why coffee can do it is because it focuses on two simple aspects of equity investing. One, choose stocks where the companies have a unique DNA to overcome evolutionary changes or disruptive changes, both inside as well as outside that company. And as a result, over a longer period of time, these companies, they tend to sustain their competitive advantages for longer periods of time. They are not dependent on external tailwinds. They are not dependent on one man driving the show inside the firm, etc., etc. And hence, like a machine, they keep delivering healthy fundamentals over long periods of time. And by definition of long, it can't be less than a decade That's one aspect. So you're choosing such companies rather than going for the broader market, which doesn't deliver anything more than 15%. And the reason why it doesn't deliver more than 15% is because there would always be a few constituents inside the broader market indices which would not grow their balance sheets over time, which would not have a healthy return on capital employed over time, and hence will not deliver a share price performance either.
So the
It's very
importance-
polite. Half the Nifty constitutes of companies who keep allocating capital for no incremental return. It's sort of unique to our country. We have a frontline index where half the companies keep allocating capital for no incremental return. So one way to think about the coffee can is you're taking the frontline index in the market and you're weeding out the poor
bad,
capital allocators. And since the index, even with poor capital allocators, generates 15%, if you take out the poor capital allocators, you get a result closer to the mid-20s.
Wow, and I want viewers to understand the importance, because you guys have put it out in your book, and here's the run rate out here, right? The run rate of 26% per annum, I think that's what you guys are saying, leads to some astronomical returns over 10 years and 20 years.
Yeah, so that's simple maths. If you can
People
compound.
it's not that simple. Half the people don't understand this, Rakshit, honestly.
Yeah, so if you compound your portfolio at 26%, right, you get to 10 times the portfolio value in 10 years. If you do it for 20 years, you get to 100 times the portfolio value by the end of 20 years.
Wow.
And most of us actually have our investing horizons lasting longer than 30 years in a row. If you can compound at 26% for 30 long years, your corpus size grows to 1000x in 30 years.
1000x.
Yeah, and inflation would have taken your cost of living to only probably around 10x.
I only switched to the coffee can 3 years ago, and just to sort of give you an example of what it's done to my portfolio, basically every year, 6 months after the year end, Rakshit, who's our coffee can fund manager, looks back at the preceding decade and he identifies companies who've grown revenues at 10% every single year, and alongside that, return on capital employed at 15%. So two metrics he uses: revenue growth 10%, ROC 15%. He looks back at the preceding decade and he puts mine and Ambit's other clients' money in the coffee can. He lets it run for a decade, right? Not only do I get 10x in 10 years, for people of nervous disposition like myself, the portfolio volatility is less than half that of the stock market.
Okay.
So you're getting a superior return, 25, 26 versus the market's 15. Your volatility is half that of the market, and you're getting richer without taking market risk. Now, again, the simplest reason I could understand that this happens is you're basically weeding out from your portfolio the poor capital allocators. As I said again, companies who keep allocating billions of dollars of capital employed, capex, without incremental return. It's simple, but it's very powerful.
So that's one part of the story, which is weed out poor allocators, focus on great capital allocators. The second part is the low churn, and hence, as Saurabh said, let the positions run. Right, that's the other. Without that, just getting the right capital allocators in a portfolio doesn't get you the mid-20s compounding sustainably. Sustainably is the key word. To get that sustainably, you need to benefit from the power of compounding by letting those positions run for long periods of time. You can't be worried that a particular stock in your portfolio, which was say 5 or 7% in year X, by year X plus 5, it has become 20% of the portfolio. Now let me trim it down. Right? You can't do those actions. You can't say let me try to double guess whether BJP wins next year's general elections or not, and hence let me put a few entrants, get a few entrants into the portfolio for a 6-month period, and then I'll go back to the great capital allocators. You can't churn. If you do that, then you kill the power of compounding. So that's the second aspect, the behavioral aspspect of it. The first aspect, as you said,
the broker obviously will be very happy. The broker would want you to churn morning, evening, want you to predict every single RBI interest rate hike or cut, every political development, every assembly election. If you're doing that as a hobby, that's fine. But if you believe that sort of behavior will make you rich, I think you really have to rethink that approach. You can either get rich or have fun. If you want to have fun from investing in the market, perhaps getting rich might not work out. But the stock market in our country can make you rich. 10x in 10 years, 100x in 20 years has happened to plenty of people that we know from sensible investing, high quality capital allocation. But it's not riveting. Getting rich is not riveting.
Point to focus on is not just the 26% CAGR. is the 26% without a sleepless night.
Yeah, sure.
It's the 26% in a sustainable way, rather than just being one of thousands of people to get that 26%.
Yeah, and I think you guys make a very interesting point as well, that why is it that you've chosen these two benchmarks? One is the return on capital and one is companies that have grown earnings for 10%. Because I think in one of the charts that you've given, which is, the Sensex returns, since I think 1990 or thereabouts, they have mirrored earnings growth exactly to the T. There's been hardly any deviation. So you buy companies which are growing earnings as the first principal rule, right?
That's right. So I think the Indian market has become, over the last 20 years, because of the amount of institutional money, both DII and FII money, the Indian market has become pretty efficient, especially in the large cap stocks, and therefore over long periods of time, earnings growth and stock market returns converge, and therefore if you buy companies who can't generate earnings growth, you're not going to get more than the index return. On the other hand, if you buy companies who are sensibly allocating capital, growing their bottom line, you grow, your prosperity grows in line with theirs. That in a nutshell is the crux of the coffee can. There is no sort of mumbo jumbo. It's a straightforward financial algorithm, very easy to implement, low cost to implement, and powerful from your enrichment perspective.
Okay, and on page number 52, guys, I mean, something that Rakshit was just speaking about, the case against churn, and you guys are making this in Exhibit 15, that the probability of gains increases disproportionately with increase in the holding horizons. I think that chart is very interesting too, should come up on your screen, but maybe you guys just want to elaborate on it.
So let me just quickly sort of ram home the point on churn, and then we'll also make the point on risk, because a lot of people ask us, why do you keep saying in the cover of the book, low risk route to stupendous wealth, right? So what this chart shows is, and this chart simply takes the underlying market, forget the coffee can for this chart. Even if you buy the Indian benchmark, even if you buy the Nifty or the Sensex, if you hold that for 10 years, you're almost guaranteed to make money, right? If you just buy the index, hold it for 10 years, you'll make money. We also show in the book, not only do you make money from buying the benchmark and holding the benchmark for 10 years, the volatility of your investment will be less than that of a government bond, right? So there's no coffee can in this. You're buying the Nifty or the Sensex and you're patiently holding on to it for 10 years, and the volatility of your portfolio is below a government bond, and you're guaranteed to make money. In fact, we show you'll make around 12-13% over 10 years with a very high probability, right? Then we say that suppose you take this point and improve the quality of your portfolio. Rather than holding the benchmark, you hold a superior subset of the benchmark. Not only will your volatility be as low as a government bond, your returns will be mid-20s. So low risk because of your patience, and stupendous wealth because of the stock selection. Right? And that's why we call it low risk route to stupendous wealth. It really doesn't get that much better than this. You're getting 10x in 10 years with the volatility of a government bond. It's not magic, it's straightforward financial mathematics.
Okay, so as the last piece on this conversation, and since we are talking about coffee can investing for this episode, would you want to share a couple of case studies or examples? I think you guys have used illustrated Page Industries very, very well. Maybe you want to speak about that.
Sure. So
as an example, of course, this is not a recommendation.
Sure. So first of all, let me give the mathematical side of Page Industries' share price. So Page Industries over the last decade or so has seen its trailing PE multiple, the real, as in without a forecast in it, the trailing PE multiple expand from somewhere around 30 times to 80 times. That's the last decade of Page Industries' PE multiple. At the same time, its share price has delivered about 45% CAGR over the decade. Right? Now, many people, when they look at these two data points, would tend to intuitively conclude that the 45% share price CAGR is an outcome of largely the PE expansion. The 30 times going to 80 times over a 10-year period is the reason why you could make 45%. Had you not had the PE expansion, you would not have been able to grow at such a healthy rate. Fact of the matter is, if you do a simple maths, the 30 going to 80 is no more than 10% CAGR contribution within the 45, right? So 35 out of 45 in terms of the share price CAGR came from earnings, because earnings compounded at that rate. So to that extent, it's first of all, we all should literally crystallize this thought in our head, that once you are looking for longer investment horizons, earnings is the only driver of share prices. It is not PE multiples. Now comes the next part, which we've highlighted in the book. How can you be confident of Page Industries delivering a 30-35% earnings CAGR going forward, and hence, how can you really invest in it even at 80 times trailing, right? That's the other part. The way Coffee Can addresses this challenge, because the challenge here is you'll say it's trading at 80 times, I need 30-35% CAGR to get the desired outcome. Page is already big enough now compared to a decade ago.
Sure.
To give me hesitation around possibility of healthy growth rates from this size onwards. Page is a well-known company now in the stock market universe versus a decade ago, and hence, what can I do by looking at Page today versus what I could have done a decade ago, etc., etc. The only way to overcome this is be confident about Page's abilities via its history. Don't second guess the future capabilities of Page without understanding the history. And there are a few charts on returns on capital employed, on revenue growth as a result that Page has delivered, which will then give you the conviction that you can bank upon this for the next decade.
Yeah, but the whole idea of getting this answer from them is to understand that it takes so much of effort to build a coffee can portfolio in the first place. So if you believe that why some part-time research once in a month or once in a week you'll be able to build a coffee can portfolio, that might not be the case. So be careful before you do that. Gentlemen, running out of time completely, but just before we end this piece, and then we'll of course be back with you guys for part 2 of this episode as well. But I just want to illustrate the coffee can portfolio which you guys have given in the book in 2017. Again, remember, it is indicative. This is no way a means of telling you that these are the stocks to invest in, but these guys at Ambit do some really quality work, and just want to exhibit that coffee can portfolio out here on the AR before we wrap it up on this show. A set of stocks really which have withstood the test of time, and you guys have chosen some fantastic names which have done phenomenally well over the last few years.
And I think I'll stress again, we do this without forecasting. We're not in the job of forecasting next year's ROE, next year's EPS growth, profit margins. You look back, use a simple filter, revenue growth and ROC, identify 15, 16 great companies, buy them and sit tight, right? That's our philosophy of buying high quality companies and sitting tight. You as a viewer might have your own, but anything which involves buying quality and being patient should make you a lot of money in India.
Great, gentlemen. Thanks so much for giving us so much advice in this first half of the episode, but we look forward, of course, to carry on this conversation. And viewers, thanks for tuning in to this leg of Portfolio.